Let's get more insight now on what happens to commodities. Francisco Blanch, he's Global Head of Commodities Derivatives Research over at Bank of America. Great to see you in person. Nice to see you.
Good to see you, Alex. Great to be here.
So help us. You've had 120 target on Brent for a while. What's going to be the top here?
Well, I think the first thing I would say is that the crisis in the oil market hasn't arrived yet. And I don't say that lightly because I think we've been in a massive global gas and power crisis for the last 18 months or so, with prices of natural gas in Europe being close to $500 per barrel of oil equivalent, right? And we've also seen recently, because of all the disruptions created with Russia, thermal coal prices rising to $100 a barrel of oil equivalent. So when essentially sand or dirt on a barge is trading at $100 a barrel, you look at oil at 120, doesn't seem that expensive. So I think we are not at the peak yet. The pressure is going to continue. But the one thing I'll say is that despite all the pain that we're seeing at the pump in this country, the U.S. is so much better off than everybody else. Because remember, we have record dollar values, meaning we have an incredibly strong dollar with strong commodity prices, which means the pain at the pump in Europe and Asia and everywhere else is way, way worse. So that's a big issue. So I think we're going to get some demand destruction. We're getting some demand destruction. Yep. But again, prices have to do a lot of work because we don't have the supply, Alex.
What does you used the word crisis just a moment ago? We're not there yet. What does the crisis look like in your mind then?
Well, we think depending on how the sanctions go in Europe, we could see the European sanctions on Russian energy. We could see maybe $150 a barrel, maybe a little higher. But I don't think this is going to be a 3-month issue, a 6-month issue. We need to fix the supply side, and it's a very, very hard thing to do. It's not just about returns. Remember, the energy sector has had terrible returns for the last few years. We've had 3 bear markets in energy in 16, 18, and 20. So it's not just about buying back stock. The history is pretty bad for energy investors.
Sorry, so you don't think this is when you say it's not a 3-month or a 6-month problem? Right. Is the implication there that it is a more than 3 or 6 month problem?
Yes, I mean, I think we're moving into probably a multi-year issue if the Russia-Ukraine situation doesn't solve itself out and we start to see flows from Russia normalizing over the course of the next 12, 18 months. And really, the big challenge here is that to fix the supply side, we also need to provide industry with some guidance as to how we're going to accomplish the energy transition. Because we did stop investing in thermal fuels, partly because of the poor returns, but also because we were supposed to be driving electric vehicles by the end of the year. Yeah. And at the same time, we kind of forgot to invest in metals.
Yeah.
Right?
And that's in essence, I think, you can blame an oil company for buybacks or whatever, but why are they going to invest in something that everyone wants to phase out? That's a really hard thing to kind of wrap your mind around. So does that mean that that we could see a spike to 150, or is this a sustainable spike to 150? Because even if we get a resolution of the Russian invasion of Ukraine, I mean, I can't imagine all of a sudden Europe's going to go great and go buy at market value Russian oil anymore.
Well, I mean, that's a great point. We definitely need to up our investment in the energy sector. And one of the challenges, again, I mentioned $500 a barrel gas in Europe, but before $500 a barrel gas, we had a spike to $350, and before that, we had a spike to $250. And what that's done to European demand for gas is it's knocked it down 3 times over the course of the last 9 months. So I guess what I'm trying to tell you, and another way to think about this, is we were looking for 3.5 million barrels a day of oil demand growth globally this year. In 2022, we're looking to get back to $100 a barrel. 100 million barrels a day. The challenge is we don't have the supply. So therefore, we can only grow our demand by 2 million barrels a day as opposed to 3.5. So to slow down the rate of demand growth, we just need a higher price. Now you're saying, okay, Francisco, so we have no inventories. We have this tons of money in the economy and people want to spend, buy. We don't have the supply. Therefore, in order to bring demand down, we just need a higher price. And that's exactly what's going on. You can call it stagflation. I call it we have no supply, we have no inventories. And therefore, prices have to do the work for us. That's it.
Can we just talk a little bit about the actual mechanics of getting molecules around the world. Europe desperately is in need of gas from around the world, not Russia in the scenario you're painting. How, at the limit, is the current supply chain for gas? We've just seen a big fire. It's had a significant impact in terms of pricing. Are we trying to squeeze every single molecule we possibly can through liquefaction plants right now? And if so, how volatile could the environment be? How easy is it going to be to knock that supply chain story off course?
Well, Guy, I mean, I'll just say, summer of 2020, European TTF gas was $1. March 2022, European TTF was $80 per MMBTU. We've gone from 1 to 80. I mean, can we get more volatile than that? I mean, it almost feels like a cryptocurrency at this point.
Yeah.
It's an incredibly volatile environment because we have a very messed up supply system. We need to expand not just LNG export capacity, we also need to expand storage infrastructure in the US, in Europe, and Asia. More pipeline capacity. I mean, just to put it into context, the amount of gas that Europe buys from Russia equates the amount of gas that China and Japan buy from the global LNG markets every year. Now, do we have the ability to create 2 Qatars overnight to essentially cut Russian gas from the European supply system? It's going to be a pretty hard thing to do. So, look, I'm not kind of giving you a lot of good answers here, but I think prices are. And to your point, the volatility of the commodity markets is going to stay incredible because, again, all I'm saying here is we're going to see more inflation, more volatility, more basis risks. And again, basis risks mean risk to the term structure of commodity markets, risks to the different prices across different regions, the prices of different commodities, corn versus wheat, gasoline versus oil. Well, all of that's going to be very volatile.
Well, I'm glad you brought that up because this is, so MLive is doing a big commodity theme this week, and the question they have is, what's going to be the best performing commodity in the back half of the year and then the worst? And it's hard to pick, right? Because there's so many that have so many supply issues.
Right. That is right, and I think the big issue here is going to be, I think, how do you address? I think on the energy side, look, coal prices are so expensive, and we are, I think, eventually going to get some response on the coal side, potentially. Although we've had an election in Australia that may tilt the supply of the world's second largest exporter. So maybe we can get some relief there. U.S. natural gas, if we have a warm winter, could end up being the worst performing commodity. Because remember, even though we're $8, $9 per MMBTU, warm weather into the winter will bring U.S. natural gas down to $3 an MMBTU. So that could be one, I think, on the energy side where we get a lot of relief. But again, we need the weather. And I'm telling you, we are right now, you asked Guy this question, are we on the edge? Yes, we're on the edge. I mean, energy supplies are limited. Growth is still very robust. And China is in lockdown. I think the best performing commodities of the year, if China comes out of lockdown, could be commodities, could be jet fuel, could be some of the metals that have been depressed because China was scaling back demand. So that's how I think about it. And then, of course, there is the food issue, which that one is a lot more difficult to forecast because of what Russia is doing to the Ukrainian agricultural sectors. So I don't think the issues are going to go away. And I even think a recession will not be a fix. I think we'll see some recessions in different parts of the world, but I don't think it's going to be the fix that we're hoping for because there's not much substitution across the complex and because everything is so tight. So even if demand comes down a little bit, that's not necessarily going to resolve the multi-year problem that we have ahead of us here.